Support and resistance are the most widely used concepts in trading the financial markets, and it's the very basic building blocks all traders should be using when trading Forex. It doesn't matter if you are a technical trader or a fundamental trader. Remember, fundamental traders are the traders who base their trades on economic news releases, while technical traders are the traders who use indicators on their charts to decide whether to buy or to sell a particular currency pair. So it doesn't matter if you are a technical trader or a fundamental trader. You can look at a chart and understand there's going to be certain areas where price just doesn't want to go through. I will explain more about fundamental analysis in the last section of this course. The reason why it's important to learn how to properly use support and resistance levels is because these levels act as floors and ceilings that can support or resist future price activity. Let's look at support levels first. The idea of support is a particular price level on a chart where price seems to receive some support from it. It bounces off that support level as if it was hitting a floor. You can identify support levels by studying a chart. Look for a series of low points where a currency pair falls to a level and then falls no further. Here you can see a strong support level. There were several points where the market was stopped from falling lower. Support is simply where price is supported. So if you look at this chart and price is falling and it can't get past this area, it bounces up, comes down, bounces up, comes down, and it's doing this again and again. That is what's known as support. If you look at a chart over time, there are certain areas in the market, as price approaches, there's always a reaction. If you look at this chart, for instance, there are areas where the market has reacted. That was support. So here we have an excellent example of a support level where on several occasions market bounced on this support level. Previously, we were looking for higher highs and higher lows and lower highs. Now we are just looking for commonalities where the wicks and the candles are touching. So every time price came down to this support level here, the buyer said this is a good price, and they start to enter buy trades and putting buy pressure on and push it up. At this point, the bulls or the green candles outperform the bears or the red candles, and the buying became so intense that it prevents the price from falling further. It's important to keep in mind that support and resistance levels are not exact numbers or exact points in the market. Many times they are a very narrow range of prices. Now let's look at the opposite of support, which is resistance. This simply means where price is resisted, where it almost appears as if the price level is providing a ceiling. If this is the resistance area up here, the market goes up and it just cannot get above that. In other words, price has been resisted at this point in the market. You can identify a resistance level by studying a chart. Look for a series of high points where a currency pair climbs to a level and then climbs no further. Levels of resistance are defined by significant high points in the market. On this chart, you can see a strong resistance level. There were several points where the market was stopped from climbing higher. At this point, the bears, which are the red candles, outperformed the bulls, which are the green candles, and selling became so strong that it prevented the price from rising further. If price are rising and reach a resistance level, price can be expected to bounce. At this area here, you can see every time it came up to this level, the sellers say, wait, not so fast, and they start to sell the currency pair and push it down. Now this is good because we can trade this. Here is an uptrend. After the market hits support, price is moving up to the resistance. The buyers ran out of steam and the sellers will move in. This horizontal level is retested on several occasions and is still having difficulty to break through. This is telling us that it's a valid resistance level up here. You will need to train your eyes to find resistance levels. Your success in Forex will depend on how good you can get in finding these levels. You need to spend time in front of your screen. If you find yourself struggling finding resistance levels, then those levels may not be very strong. Drawing resistance levels on the longer term time frames are more reliable. For example, a resistance line on the 1-hour chart is far more reliable than a resistance level on a 5-minute chart. You need to have a solid understanding of resistance levels because these levels indicate turning points in the market and provide excellent opportunities for sell trades. Now, understanding support and resistance and know what they are, you can begin to look at charts a little bit differently. Now, does support and resistance always work? Of course not. But it does give you a roadmap on where you want to enter a trade. Remember, with Forex trading, timing is everything. In my experience, the best trades are made around strong support and resistance levels because we want to get the odds in our favor. We will look for some kind of reaction close to a support and a resistance level. Now, this some kind of reaction can be in the form of a particular candle formation or a trend line or even an economic news release, which I will be covering in the next lecture. So, how exactly do we trade Forex using support and resistance levels? It really boils down to trade candle patterns from confluence levels in the market. Now, if that sounds a little confusing to you right now, sit tight and I will explain. Because in the last section of this course, I will be putting everything together that you've learned so far. We will combine Japanese candlesticks with trend lines and support and resistance levels, and will base our entry and exit points where there are confluence of events.